Let's start off with a look back at what's going on now and how it compares to periods in the past.
Yeah, some pretty compelling parallels are between where we're at now and where we were in the late 90s. In the late 90s, you were at that time at the tail end of the longest economic expansion in history.
Mm-hmm.
It's now the second longest because the one we're in right now is the longest. The longest bull market in history. Now it's the second longest because we're in the longest bear market or bull market currently. Additionally, you had this idea that the business cycle doesn't exist anymore. Recessions had gone away. If you're sitting there as an investor in 1998 or 1999, it's a very binary type of market environment. Either we're going to go up another 80% or we're coming down 40%. When you're at these valuations, there's this much debt, we've been this long without a recession, the outcomes become more extreme.
As we think about the parallels to the 90s, what scenarios do we see as we move into the 2020s?
You know, we have to have titles for these scenarios.
So give us something from the 90s.
Exactly. So we were channeling, you know, what are the top pop hits, the golden age of pop music, if you will, to come up with our scenario titles. Our base case, the late, great Whitney Houston. It's not right, but it's okay.
Okay.
It's not right, but it's okay.
That's a 50% probability. And the idea there is you look at the amount of debt in the economy, you look at stagnating earnings growth, slowing economic growth, and how expensive stocks are. It's certainly not right, but our base case is the Fed's going to make it okay. Because they are going to provide enough liquidity and be proactive enough that they're going to continue to delay any sort of reckoning for these things.
All right.
So it's not a great environment. It's not something you should feel great about, but just know that all this economic fragility we see, the Fed liquidity we're predicting will be greater. So you can still make a decent return. And compared to last year, how we look at it is this year compared to last year, in this type of an environment, there's less upside potential.
Mm-hmm.
You know, it's going to be tough to recreate another 31% return on the S&P 500. But there's also less downside scenario.
All right, it's not right, but it's okay.
Our most bearish scenario is called Bye Bye Bye. The NSYNC song Bye 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 starts off, it might sound crazy, but it ain't no lie. You know, stocks can go down and recessions do happen.
Baby, bye, bye, bye.
So if you think about a situation where, you know, the expectations are you're going to get this recovery in global manufacturing activity, everything's going to be fine with trade, and the consumer is very strong. So the consumer is going to continue to drive the U.S. economy. Well, the reality is if that manufacturing recovery doesn't come, which certainly is a high probability, especially if China doesn't play ball and stimulate their economy, and when we look at the consumer, we see much more fragility, that they're on a much less stable footing than I think is implied by consensus. You can get a not so pretty economic scenario. You know, you're talking about a very low growth type of scenario. If you combine that with the Fed making a mistake. So, you know, when the Fed started buying $60 billion worth of Treasury bills last fall in October, it took almost 4 months for us to have a down week on the S&P 500. It definitely supported stock prices. Now, they've come out and said that they're going to start tapering those purchases starting in April. If they do that, and you believe in symmetry, we could be coming right back down. So if you combine some bad economic data with a Fed mistake, then you can definitely see a down 20% type of a market scenario is in the cards. If that type of a delayed reaction or Fed mistake results in actual layoffs and actual defaults, then the cat's out of the bag, and we could have some serious downside.
So Fed mistake, bye, bye, bye.
Yeah, you should buy high quality bonds because in that situation, the 10-year Treasury note yield starting right now at 1.5% is probably going to 0.75% or lower.
So give us the final scenario.
The rosiest, Britney Spears, Baby One More Time.
Hit me, baby, one more time.
Investors must confess they still believe the longest bull market in history has room to run. And the idea is central banks and governments around the world are willing to hit the global economy with stimulus one more time. And you could see a situation when you're this late cycle, if governments and central banks get scared or pressured into providing more stimulus, you could see a tech bubble-like run-up. If you start to think, if we get 10% earnings growth and the price multiple, the price to earnings ratio on the S&P 500 expands, say another 2 turns, so from somewhere around 18 to 20, you're looking at 20% upside.
So
So
from here,
20% upside. We have a 30% probability on that. I always like to say, recessions happen all the time. They happen regularly. The tech bubble happened once, so it's a lower probability event. But if we're already so close to it, it becomes a higher probability event, right?
sure.
You have a much higher probability of reaching the peak of Everest if you're already halfway up,
yeah.
and we're already halfway there.
Yeah. And given the year we're in here in the U.S., where we have an election in front of us, how does that impact these scenarios, in your opinion?
It definitely impacts them a lot. So in our base case scenario, we're looking for anything that seems like business as usual or gridlock. And that's still the highest probability outcome. In our bear case scenario, that would be a situation where, say, you were to actually see one of the far left candidates that are perceived as less market friendly, like a Bernie Sanders or an Elizabeth Warren, elected, as well as a Democratic House and Senate. That would be the least market friendly outcome. And then the maybe one more time, the bullish scenario, that's where, regardless of who gets elected, we call it here as one of our key themes, crowd pleasers only. One of the few things that just about every candidate can agree on is infrastructure spending, which is fiscal stimulus. So if that's the only thing that comes out of this, you can see how we could juice the economy even more.
Yeah. Awesome.